Multiple surveys continue to show that one of the biggest misconceptions first-time homebuyers have is that they are required to have a 20% down payment. If you have this, if you have it saved up, great, that may be good. But we're going to look today at why you may not want to put 20% down payment on purchasing your first home or your second home for that matter. My name's Miles Pitcher. I own Superior Lending. Been in the business for over 20 years. So we'll look at this today. Is 20% down worth it on your conventional loan? I do want to mention before we start that we're primarily talking about conventional loans today. FHA has mandatory mortgage insurance, and they call theirs mortgage insurance premium, MIP. Conventional loans have PMI, private mortgage insurance, and we're focusing on that. We're not looking at VA loans because they don't carry mortgage insurance, but we'll also compare an FHA loan here at the end of the show to be able to show the difference on these. So, number one, PMI on a conventional loan, it can be removed in the future without having to refinance the loan. It's based on debt ratio, credit scores, and I'd also add in loan to value. And if those are very good, very much in your favor, you'd be surprised how small your PMI can be. The beauty of this is if you're putting in a large down payment, 20% down, if you opt for a smaller down payment, you have money that you can use for other things such as paying off other debts, doing home repairs, things that add value to the home, or even possibly looking at buying additional rental properties, etc. Again, on a conventional loan, PMI is temporary. Once you show enough equity in the home, you can get it removed. And that can come from a couple of different ways. Number one, you just pay down the loan balance and get to where you have 20% home equity. The other option is the home continues to go up in value. And once you've been in the home for 2 years, you can request your lender to appraise your home and see if you've achieved that 20% equity in your home. Typically, the combo between the home going up in value and you paying down the loan is how you achieve enough equity to get the PMI removed from your loan. I'll link to another video I have that talks about getting PMI removed. Mortgage insurance, again, is determined by your credit score, your debt to income ratio, or how much of your income goes towards paying your debts, and your loan to value. There are a few other factors that sometimes give you benefits, such as having 2 borrowers on the loan, and there are special first-time homebuyer programs that will also give you a reduced PMI rate. So let's look at this comparison here. First, I've done an FHA loan 5% down. You can do as little as 3.5%. I've done a conventional 5% down. I've done that just so that we're getting an apples to apples comparison. And you can see that the down payment amounts on this it's a $500,000 purchase, so it's a $25,000 down payment. If you were to do 20% down, you're $100,000 in your down payment. You can see the different interest rates here, and you can see the principal and interest. You can see the mortgage insurance amounts, the MI, and so let's look at those real close. FHA has $196 in mortgage insurance. FHA has a standard mortgage insurance rate regardless of where your credit score is. So you may have a 620 credit score or you may have 800. Your your mortgage insurance is going to be the same. So for my lower credit clients, anybody typically under 700 credit score, FHA is going to give you a better price on your mortgage insurance. You can see here with this scenario, we've put in a 780 credit score. This client, see how much less their mortgage insurance is? While their principal and interest is going to be higher, their mortgage insurance is quite a bit lower, giving them a lower monthly payment than the FHA loan. And then you can see that there is no mortgage insurance on the 20% down conventional. So let's take a look here. If you put $100,000 down, you're going to get principal and interest of $25.28. If you put $25,000 down and do conventional, you're going to have a monthly payment plus the mortgage insurance of $3,078. You save $75,000 in down payment money, but your monthly payment is going to be $550 higher. So just weigh that out as you look at that and say, hey, can I go pay off my cars, credit cards, or invest that money? You don't have to have that 20% to get into a home. Homeownership is awesome. Dave Ramsey often promotes that you have to have 20% down to buy, or you should before you buy your first home. Don't fall into that. Okay. We believe that once you have 5% down, it's a great time to look at buying a home. And then we measure your budget, make sure you're comfortable with your monthly payment. We get you into a home. Here's how you can reach out to my team if you have any questions, or we can help you on quoting out any loans that you may need. Thanks for watching the video. Have a great day.